Steve.
Kelly, yeah, unfortunately with the CNBC All-America Economic Survey this quarter, we're breaking records, but not the best kind of records, the worst kind of records. If you take a look at our poll of 1,000 people across the country, what you'll find is that 69% are pessimistic about the current situation in the economy, and they're pessimistic about the future. That's an all-time high. 53%, a record high, are saying the economy will get worse, and 24% saying that is a bad time to invest. That's a record low. The middle one there, I forgot to tell you, is a record high. I want to explain to you how we got here. Usually when people are negative about the current situation, they think things will get better. You can see that in the data from 2008, when 95% thought the economy was lousy, but 39% thought the economy would get better. It's not the case right now. If you take a look, 85% think the economy is fair or poor, but only 19% or 18% see improvement.
Okay, this is really important because when people say, oh, everybody's bearish, everybody's pessimistic. I heard somebody on CNBC today say that this recession, is the most forecasted recession we've ever seen before. So maybe it's not going to happen. You know, the contrarian indicator, everybody's negative, everybody's bearish. So that means that the economy is going to have soft landing and the stock market will go higher instead. Be careful what you wish for and be careful what your assumptions are. Because back in 2008, we had the same phenomenon. The stock market, believe it or not, in the summer, in the aftermath of the collapse of Bear Stearns, was actually rallying higher. But the sentiment was absolutely horrific. Now, a lot of us back then were saying, this is not going to end up pretty good. The system is going to crash. There is no way we can get out of this without a systemic crash. And a lot of these organizations go and bust. A lot of bulls back in the day ridiculed us, made fun of us, said, hey, you're too bearish. You have no idea. The market is going higher. The Fed is intervening. JP Morgan took over Bear Stearns. No problems. The Fed will get it all fixed. And then we all know what happened. So sometimes these kind of indicators, when we see people negative and the sentiment really bearish, it's happening for a reason. And that reason is?
And one of the reasons, if we look down and we dig down further, we look at what's happening with wages versus inflation. Just 5% say that their wages are going up faster than inflation. 26% tell us they're staying about even. But 67% believe they're falling behind when it comes to inflation.
So again, when we talk about, oh, the inflation is going down, we're getting closer to Fed rate cuts, I don't know what you're looking at, but the inflation problem is far, far from over. We feel it every day. Our wages are lagging behind. And if you tell us that, hey, things will sort themselves out, if you listen to the good professor, for example, from Wharton today, who said that inflation is dead, we're already at the 2% target. Or a real estate mogul, Burry, who says that rents are crashing. That's what people in the bubble are looking at, the Wall Streeters, who just want the rate cuts so they can rally the stock market. But at the end of the day, the core and the heart of the stock market is corporate earnings. You can ignore them all you want, but they're going to come in play sooner or later. What drives corporate earnings? The answer is the consumer. And the consumer right now not feeling pretty good. You know, I heard CEO of Bank of America today, and they asked him, how is the consumer doing? And he says, oh, the consumer is robust and resilient. They have plenty of cash. And I say, how the fuck do you know? How about we talk to the actual consumer? Because the consumer says, no, things are not good. My wages not keeping up with the inflation rate. My rents, I'm stuck now. I'm paying 40-50% of my income in rents alone. Not to mention gas bills, utilities, the grocery store. I don't have anything left to stimulate the economy with. So corporate earnings are not going to be pretty good. The headline reads, more U.S. consumers are falling behind on payments. The consumer is getting squeezed. The consumer is far from being strong and resilient. What are these people talking about, folks? On top of that, inflation is not over. Today we got the data from China. Q1 GDP up 4.5% year on year, above expectations. Now China needs more commodities, more metals, more grains, more softs, and certainly more energy. That's inflationary. That's not going to stop anytime soon. China is stimulating the economy right now. China is where we were at in late 2020 and 2021. They're stimulating their economy, which means demand will move higher, and that will keep inflation higher for longer. It is no wonder why the odds for the 25 basis points in the May meeting now pretty much at 90%. It's in the bag. And soon enough, we might even talk about 50. Although I don't think they're going to do it, I think they're going to do more 25s over and over and over again. We got the commentary from San Luis President Fed Bullard, whatever his name is. He says recession fears are off base and urges more hikes. Today from Atlanta, insider trader Boystick was on TV. He said recession is not his base case, and he sees a rate hike coming. Sure, he says raise and pause, but they said that since December, folks, and it never happened. You know when they say the recession is the most forecasted in history? I think these Fed rate cuts and pauses, the pivot, is the most forecasted in history. Everybody been talking about a pivot since last year. A few months after the Fed started tightening the monetary policy, they've been already talking about pivots, pauses, rate cuts. They never happened because inflation is still here. And the problem with all of this, sure, the banking crisis is averted for now, but if we're going to go back into fighting inflation, that means rates will move higher. Rates will stay higher for longer, which means the systemic risk will come back into the picture. If it's not from banks, look at what's going on in commercial real estate. The headline reads, Brookfield defaults on $161 million office property debt. And we're going to see more and more of that as rates continue to move higher and stick higher for longer.